Welcome back to the deep dive. Today, we're tackling something that, well, it touches all of our lives, often with a bit of mystery, maybe some frustration. The tax code.
It definitely can feel like a maze sometimes.
Exactly. But what if we thought about it more like a game, a strategic one with rules meant to encourage certain moves? Our mission today is to basically give you the playbook for the One Big Beautiful Bill Act, signed into law July 4th, 2025.
Right, it's the biggest tax legislation we've seen since 2017.
Huge. And we're going to cut through all the jargon, get straight to what you need to know about how this impacts you, whether you've got a W-2 job, run a business, or you're planning for retirement.
Yeah, and what's really fascinating, I think, is how the government uses the tax code to structure incentives. This bill, it really throws that dynamic into sharp relief. We're not just looking at what changed on paper, but really why those changes happened and, who ultimately benefits the most.
Yeah.
We'll connect those dots, maybe expose some surprising ways the financially savvy leverage these rules, and also highlight what options are really out there for everyone.
All right, let's open up this playbook then. This big, beautiful bill signed by President Trump. What exactly is it in a nutshell?
Well, putting it in the bigger picture, it's a pretty broad piece of legislation pushed by Republicans, officially called the One Big Beautiful Bill Act.
Yeah.
And it's significant because it bundles together major tax cuts with spending reductions, new border security stuff, and also some shifts in energy policy. It's a really comprehensive package.
Okay, comprehensive. So let's dive into the tax part first, the adjustments that hit individual taxpayers. What are the major shifts we should be watching?
The most, I'd say, monumental change is making the individual income tax cuts from the 2017 TCJA permanent.
Okay, the Tax Cuts and Jobs Act ones.
Exactly. Those lower rates, from 10% up to 37%, they're now locked in. They won't snap back to the higher pre-2017 levels. So like if you were happy being in that 12% bracket, you're not going to suddenly jump back to 15%.
Yeah.
It gives people some long-term certainty for their planning.
That does sound like a win for many. What about the standard deduction? That's a big one for so many people filing.
Absolutely. And that's another big win here. The bill permanently extends and significantly increases the standard deduction. For 2025, it's jumping to $15,750 for single filers.
Wow.
And $31,500 for joint filers. I mean, think back to 2017. It's like $6,000 and $12,000.
Huge difference.
It really is. And crucially, these amounts are indexed for inflation. They'll keep adjusting each year. So the average person, especially folks around that median income, say $70,000, they should see a noticeable bump in their take-home pay just from this.
Okay, good to know. And beyond those broad deductions, what about families? Any changes to the child tax credit?
Yes. For families, the child tax credit is also permanently extended. And it's increased a bit, from $2,000 to $2,200 per child. Up to $1,700 of that is refundable now.
Good.
It's also inflation adjusted, which is key. And there's a new requirement. At least one parent needs a Social Security number to claim it. The income phase-outs are still pretty high, $200,000 for single, $400,000 for joint filers. The thinking behind this, according to the sources we looked at, seems to be an attempt to incentivize having more children, given the declining birth rates in the U.S.
Interesting policy goal embedded there. Are there any other, maybe more specific temporary deductions tucked into this bill for certain groups?
Yeah, this really shows how the tax code gets used as a policy tool.
Yeah.
There are several temporary deductions. These are only effective from 2025 through 2028. So first, there's a senior bonus. It's an extra $6,000 deduction for people 65 and older, but only if their income is below $75K single, $150K joint. Then, there's a deduction for tip income. Up to $25,000 for workers earning tips, provided their income is under $150K single or $300K joint. That's big for service industry folks, Vegas, restaurants, and it specifically includes credit card tips too.
Right.
Then, an overtime pay deduction. Up to $12,500 single, $25,000 joint, same income limits as the tip one. Helps boost take-home pay for those working overtime. Though it's worth noting that only affects a smaller slice of the workforce, maybe 8% of hourly workers, 4% salaried.
Still helpful for those it applies to.
Definitely. And finally, an auto loan interest deduction, temporary again. Up to $10,000 for interest paid on loans for vehicles assembled in the U.S. This one phases out if your income is over $100K single or $200K joint.
Yeah.
Clearly aimed at boosting domestic car sales.
Oh, a lot of targeted but temporary relief there.
Exactly. Key things are the temporary nature of those income caps. Got to watch those details.
Okay, let's pivot to something that's always contentious, especially for homeowners in certain states. The SALT deduction, state and local taxes. What's happening there?
Right, the SALT cap. That was a big deal from the 2017 law, capping it at $10,000. Well, this bill temporarily increases that cap to $40,000.
40,000, that's a big jump.
It is. But again, temporary 2025 through 2029, it reverts back to $10,000 in 2030. And there's an income limit here, too. It applies fully for taxpayers with income below $500,000. It phases down above that, but it never goes below the original $10.
So significant relief for people in high-tax states like California, New Jersey, New York.
Absolutely. For those 5 years at least. The argument, from an economic perspective, was that the $10 K cap was hurting home values and investment in those states, so this is meant to ease that pressure.
Now, I've heard whispers about something called the SALT workaround. How does that fit in, especially now with this higher temporary cap?
Ah, yes. This reveals, another layer of strategy in the tax game. While the $40 K cap helps a lot of W-2 earners and homeowners, there's a more advanced play, mostly for self-employed folks and owners of pass-through businesses, LLCs, that's core. Over 30 states now have laws, like California's AB 150, that allow for this workaround. Basically, the business entity, the LLC or S-Corp, pays the state income tax for the owner at the entity level.
Right.
The business then gets a federal deduction for that state tax payment, and the owner gets a corresponding credit on their state tax return. The net effect: these business owners can effectively deduct 100% of their state and local taxes at the federal level, completely bypassing that $10 or even the temporary $40 K cap, even if they're making millions.
Wow, so the cap is almost irrelevant for those who can use this structure.
For those specific business owners in those specific states, yes. It's a prime example of how complex and, strategic the tax code can be.
Speaking of significant wealth and strategy, what about state taxes? Any changes there?
Yes, the bill also makes a permanent change to the estate tax exemption. It's bumped up significantly. It's now $15 million per individual or $30 million per couple. And that amount will be indexed for inflation starting in 2026.
$15 million per person.
Correct. That means far fewer estates will actually be subject to federal estate taxes. It allows for a much greater amount of wealth to be passed down tax-free to heirs, a big benefit for high-net-worth families.
Okay, let's shift gears slightly. There's this new initiative, sounds pretty innovative, called Trump Accounts for Kids. What are these exactly? How do they work?
Right, these are new. The bill sets them up as a dedicated children's savings program. The government actually kickstarts it with a $1,000 treasury deposit for kids born between 2025 and 2028.
$1,000 from the government.
Yep, a starting seed. Then parents can contribute up to $5,000 each year. The money grows tax-deferred, typically invested in broad index funds. It becomes accessible after the child turns 18, specifically for qualified expenses like college, buying a first home, or even starting a business.
Tax-deferred growth, that's good. Any catches?
Well, there's a key difference compared to, say, a Roth. If the money is withdrawn before age 30 for something not on that qualified list, then it's hit with a 10% penalty and it's taxed as ordinary income. So there's a bit of a string attached for non-qualified early withdrawals.
Okay, so an interesting new option. But how does it stack up against existing ways families build wealth for kids? Is this the best way now?
That's a really critical question for parents planning ahead. While these Trump accounts are, a new tool in the toolbox, for many situations, using a Roth IRA for a child might actually be even more powerful long-term.
A Roth IRA for a kid, how does that work?
Okay, so if you have a legitimate business, you can put your child on the payroll for actual work they do. You can pay them up to the standard deduction amount, which is $15,750 in 2025, and they wouldn't even need to file a tax return because their income is below the filing threshold.
Right.
From those earnings, you can then contribute up to the IRA limit, say $6,000 or whatever it is that year, into a Roth IRA in their name. The huge advantage: that money grows completely tax-free, and withdrawals in retirement, also tax-free.
Completely tax-free.
Completely.
Yeah.
And even for things like a first home purchase down the line, the contributions can often be withdrawn tax-free and penalty-free. You avoid that ordinary income tax hit that the Trump account has for non-qualified withdrawals. It's a really powerful, often overlooked strategy for true tax-free wealth building over decades. More flexible in many ways.
That's a fantastic comparison. Okay, let's switch focus again. Beyond individuals, this bill seems loaded with incentives for entrepreneurs and investors. What are the big headlines on the business side?
Yeah, there's some major items here. Probably the biggest is the permanent restoration of 100% bonus depreciation.
100%. Back again.
Back again, and permanent this time, for qualified property put in service after January 19, 2025. This means businesses can immediately write off the entire cost of eligible property in year one. We're talking machinery, equipment, software. And significantly, vehicles with a gross vehicle weight rating over 6,000 pounds. Think large SUVs, pickup trucks, vans.
So that $100,000 G-Wagon example you mentioned.
Exactly. If a business buys that $100,000 vehicle, uses it 100% for business, they can deduct the full $100,000 in the year they buy it, even if they finance most of the purchase.
Wow, that's a huge immediate tax break.
It's a massive incentive to invest in business assets, absolutely. It also applies to certain improvements to real estate, known as qualified improvement property.
Now, you mentioned real estate. This sounds like it could be especially powerful there. How does this depreciation play out for property investors? And are there, more advanced strategies?
Oh, absolutely. This is where things get really sophisticated for real estate players.
Hmm.
The 100% bonus depreciation interacts powerfully with something called cost segregation studies.
Cost segregation. Explain that a bit.
Okay, so when you buy a building, most of it gets depreciated slowly over 27.5 years for residential or 39 years for commercial. A cost segregation study basically dissects the building. It identifies components inside the building like carpeting, cabinetry, special electrical, plumbing fixtures, even landscaping that have shorter useful lives under the tax code, maybe 5, 7, or 15 years.
Ah, okay.
By identifying these, you can accelerate the depreciation on those components. And with 100% bonus depreciation now applying to many of these shorter-lived assets, you could potentially write off a huge chunk, maybe 30–40% of $1 million building's cost almost entirely in year one. It creates massive paper losses up front.
Huge paper losses. Okay, so how do investors actually use those losses?
Great question. Now, a strategy that we often discuss with clients, but it's worth sharing more broadly, is the self-rental strategy. Let's say you own an active business, like the media company example. And you personally, or through another entity you control, own the building that your active business operates out of, like the studio.
Okay, separate ownership, but used by the main business.
Exactly. There's a specific IRS rule, an election under Section 469, that allows you to formally group your active business activity with that rental activity. If you make this grouping election, the big paper losses generated from the cost segregation study on the building can then be used to directly offset the income from your active business.
Without needing to be a real estate professional. Because normally passive losses can't offset active income, right?
Precisely. This grouping election bypasses that typical limitation. It's a very powerful way for business owners who also own their own real estate to generate significant tax losses that can shelter W-2 income, 1099 income, or active business profits.
That sounds like a game changer for the right situation. Any other significant perks for businesses in this bill?
Yes, a couple more big ones. The bill allows businesses to go back to immediately expensing their domestic research and development, or R&D costs. For a while, businesses had to amortize those costs over 5 years, which wasn't great for cash flow or innovation. Now, you can write them off in the year you spend the money.
Good for tech and manufacturing.
Definitely. And also, the Qualified Business Income Deduction, the QBI deduction, has been made permanent.
That's the 20% deduction for pass-throughs.
That's the one. Crucial for LLCs, S-Corp, sole proprietors. It gives a 20% deduction on their qualified business income. This is especially important if your business profit is over, say, $60,000, because it helps offset that hefty 15.3% self-employment tax.
Right, the SE tax.
The strategy there, as we discussed, is setting up an S-Corp if you're making enough profit. Pay yourself a reasonable salary. That part is subject to SE tax. But take the rest of the profit as distributions. Those distributions are not subject to SE tax, and they generally qualify for the 20% QBI deduction. It's a fundamental tax-saving structure for profitable small businesses.
Okay, so significant tax benefits for businesses making investments and for pass-through structures. But this bill isn't just about taxes, right? It affects government spending, too.
That's correct. It's very much a comprehensive fiscal package, not just a tax cut bill. It includes about $1 trillion in spending cuts projected over the next decade.
$1 trillion. Where are those cuts coming from?
Primarily from programs like Medicaid and the Children's Health Insurance Program, CHIP. The mechanism is mostly through tighter eligibility rules and implementing or strengthening work requirements. For instance, the bill mandates 80 hours of work per month for able-bodied adults under 65 to receive SNAP benefits, food stamps.
Okay.
From the perspective of the bill's proponents, these spending cuts are intended to help offset the revenue lost due to the tax cuts.
So looking at the whole picture, the tax cuts, the spending cuts, who, based on the analysis, might actually end up worse off financially under this bill.
Well, connecting the dots from the sources we reviewed, it suggests that individuals at the very lowest income levels, say earning $45,000 or less annually, might actually see their overall tax burden increase. It's a combination of factors. Cuts to certain existing tax credits they might rely on, like the Earned Income Tax Credit or the American Opportunity Tax Credit for education. And that's coupled with the reductions in social safety net programs like Medicaid and SNAP benefits, which disproportionately affect lower-income households.
Okay.
The interpretation is that the bill aims to reduce dependence on government subsidies, which means those who currently rely on them could be negatively impacted.
And who benefits most?
Generally, the consensus from the analysis is that middle-income individuals, and that's defined pretty broadly here, from around $50,000 up into the millions, are expected to see the largest net benefit.
Got it. And what about other major policy areas touched by this bill? You mentioned energy and border security earlier.
Right. On energy, the bill takes steps like repealing previous methane taxes, it unlocks more federal lands for oil and gas development, and it even includes investment in coal production. A definite shift in energy policy focus. On the defense side, there's a significant boost to military spending, over $100 billion more. Funds are earmarked for things like a Golden Dome missile defense system, shipbuilding, and nuclear deterrence. For border security, it allocates tens of billions towards constructing more border wall sections and hiring 10,000 additional ICE agents. So clear shifts in spending priorities across the board.
I remember the Inflation Reduction Act had a lot of buzz around electric vehicle tax credits. How does this new bill affect those?
Yeah, those are significantly impacted. This bill essentially eliminates hundreds of billions of dollars in clean energy tax credits that came from the IRA.
Eliminates them.
Pretty much. The popular $7,500 federal tax credit for buying new electric vehicles. That's set to expire on September 30th, 2025 under this bill.
So not much time left for that one.
Very little time. And it also gets rid of the residential clean energy credits, for putting solar panels on your roof or making other energy-efficient home improvements. Those go away after 2025 as well. The perspective here, from the bill's side, is that the government is stepping back from subsidizing these specific technologies, letting consumer choice and the market dictate demand without these artificial drivers.
Okay, quite a reversal on those green incentives. So bringing this all together, what does it mean for the average person trying to navigate their finances? You often say the tax code is a game. Can you unpack that a bit more? How does someone even start to play strategically?
Right. I really do think viewing it as a game is the most helpful mindset. And the reality is the wealthy, or perhaps more accurately, the financially educated, simply tend to know the rules of this game much better. If you're, let's say, uneducated about the available strategies, the deductions, the credits, you often end up, well, tipping Uncle Sam much more than you need to.
Dick Uncle Sam, I like that.
Yeah. The system isn't inherently rigged against anyone, but it is absolutely structured to reward certain behaviors. Who gets the most deductions and credits? It's usually business owners and investors. Why? Because they're taking risks the government wants to encourage, investing capital, creating jobs, developing real estate, producing energy.
So the incentives are built in for risk takers.
Exactly. Whereas most people working standard W-2 jobs, well, they have far fewer levers they can pull within the tax code. Their deduction options are much more limited.
That makes sense. Which raises a really practical question. If you want to learn these strategies, who should you talk to? Is a CPA the go-to, or is it someone else, like an enrolled agent?
That's a super important distinction, and one that causes a lot of confusion. Most CPAs, certified public accountants, are fantastic at compiling historical data, doing bookkeeping, accounting, and accurately filing your tax returns based on what already happened.
Okay, compliance focus.
Right. An enrolled agent, or EA, is different. They're licensed directly by the IRS, specifically focused on taxation. They pass 3 rigorous exams purely on tax code, individual, business, and ethics procedures. Their expertise is often geared more towards consulting on the tax code, interpreting it, and strategizing how to leverage it proactively to minimize tax liability.
So EA for strategy, CPA for filing and accounting, generally speaking.
Generally, yes. For forward-looking tax planning and strategy advice, an EA is often more specialized. For filing accurate returns, managing books, and broader financial accounting, a CPA is excellent. Many people use both.
Okay, that's helpful. Let's get really practical now. What are some actionable steps someone can take based on their situation? Let's start with someone earning a W-2 income, maybe between $60,000 and $200,000.
Okay, for a W-2 earner in that range, the absolute first step is maxing out any tax-advantaged retirement plans available, especially a 401k if your employer offers one.
Max out the 401k, traditional or Roth?
Good question. It depends a bit on where you are in that range. If you're closer to the 60K, 80K mark, Prioritizing a Roth 401k often makes sense. You pay tax now, but get tax-free growth and tax-free withdrawals in retirement. As you get closer to $200, the immediate tax deduction from a traditional 401k becomes more valuable, reducing your current taxable income.
Okay. What else beyond the 401k?
Look into contributing to a traditional IRA as well. Depending on your income and 401k participation, you might get another deduction there, up to $6,000 or $7,000 depending on the year and your age. Beyond those standard retirement accounts, it gets trickier for W-2 earners. You might start looking at investments that generate active losses to offset your W-2 income.
Active losses. Like what?
Things like direct investments in oil and gas drilling programs. Certain upfront costs can sometimes be deducted immediately, creating a paper loss that can offset active income. Plus, there's often a depletion allowance later, which makes some of the revenue tax-free.
Interesting. Oil and gas.
Or potentially getting involved in short-term rental real estate, like Airbnb. If you actively participate enough, the depreciation losses, especially with 100% bonus depreciation, can sometimes be used against W-2 income. But the rules there are complex.
Okay. Requires more active involvement. Now, what if you're self-employed in that same $60K to $200K income bracket? How does the playbook change?
Oh, it changes dramatically. If you're self-employed, maybe operating as an LLC or sole proprietor, and your net profit is consistently over $60,000, you absolutely need to look at electing S corporation status
S Corp. Why is that so critical?
because of self-employment tax. As a sole proprietor or standard LLC, you pay 15.3% SE tax on every single dollar of profit.
Ouch.
Yeah, with an S corp, you pay yourself a reasonable salary for the work you do. That salary is subject to payroll taxes, which includes the SE tax components. But any profit above that reasonable salary can be taken out as a distribution, which is not subject to the 15.3% SE tax. And it generally qualifies for that 20% QBI deduction we talked about. Huge savings.
So split income between salary and distribution. What else?
Definitely claim a home office deduction if you have a dedicated space. Consider buying that heavy vehicle over 6,000 pounds GVWR for the business to get that massive first-year depreciation write-off. And absolutely use the Augusta rule.
Remind us what that is again.
It's Section 288G of the tax code. It lets you rent your personal residence to your own business for up to 14 days per year. You personally don't have to report that rental income. It's tax-free to you. But your business gets to deduct the rent it paid as a legitimate business expense, assuming it was for legitimate business purposes like meetings, planning sessions, etc.
Rent your house to your business, tax-free income personally, deduction for the business.
Correct. You just need to document it properly, have a rental agreement, charge fair market rent, actually use the home for business on those days. But it's a fantastic legal loophole.
That is a huge shift in perspective, thinking about expenses that way. But, some of these strategies, especially the more aggressive ones, sound like they might be pushing boundaries. What about things that are technically legal but maybe attract more IRS scrutiny?
That's a really valid point. You have to understand the line between optimization and, well, getting too aggressive. The IRS is real. They have auditors. They want things to be legitimate. There are structures the very wealthy use, like, say, sophisticated charitable LLCs, or putting assets like luxury cars or art into a private family foundation. The idea is often to generate current tax deductions while effectively retaining some control or benefit from the assets. These can be legal if structured perfectly. But they come with very high setup costs. Think $10, $20 just to start, plus ongoing admin fees, maybe $5 a year for a foundation. You usually need a significant net worth, well over $1 million, for them to even make sense. And they're absolutely on the IRS's radar. If they suspect abuse, like you're primarily using the foundation assets for personal enjoyment or taking improper loans from it, you're asking for a deep, painful audit. They're on the IRS's naughty lists, so to speak.
A naughty list. Good to know what's on it.
Yeah.
Speaking of audits, how likely is an audit for the average taxpayer, really? And what triggers them?
The actual odds are lower than most people think. For incomes under $500,000, the audit rate is typically less than 1%.
Less than 1%.
Yeah. It does go up with income, maybe 1.2% for the $1 million to $3 million range, and around 2.6% for those over $10 million. Still pretty low overall. The main red flags. Big discrepancies, like underreporting income shown on 1099 forms the IRS already has. Math errors. And suspicious-looking numbers like claiming exactly $10,000 for 5 different expense categories. That looks made up.
Round numbers are bad.
Perfectly round, large numbers can be, yes. The IRS uses algorithms, comparing your return to others in your industry using NAICS codes. If your deductions look way out of whack compared to the norm for your income level and business type, that can trigger a look. If they send a notice asking for clarification and you ignore it, that's when a human auditor usually gets assigned. And audits aren't quick, usually 9 to 12 months.
Okay, so respond to notices. Are there any, I don't know, clever but legal ways to potentially reduce your audit risk in the first place?
Well, there are a couple of tactical things people sometimes do. First, if you're self-employed, filing for an extension pushing your deadline from April 15th to October 15th might slightly lower your risk.
How?
You just end up in the huge pool of other business owners and complex returns that file later. The IRS gets swamped. You blend in more statistically. Second, and this sounds counterintuitive in our digital age, but paper-filed returns actually tend to get audited less frequently than e-filed ones.
Filing by paper.
Really?
Yeah. They're just harder for the IRS's automated systems to scan, process, and flag compared to neatly formatted digital data. And interestingly, some data suggests that people who file right on the April 15th deadline actually get audit notices earlier, sometimes by mid-May. Filing earlier doesn't necessarily help avoid scrutiny.
Fascinating tactical points. Now, you shared a story with me earlier about a client who wrote off a yacht. That sounds pretty audacious. How on earth did that work, right? That story really highlights just how far you can sometimes go if the business purpose is legitimate and documented. This was a high-end real estate agent. She claimed her yacht as a business vehicle, her justification. She used it regularly to show clients waterfront properties from the water, giving them a unique perspective they couldn't get otherwise. She also used it to host broker preview events.
Okay, but how did she prove that to the IRS?
Meticulous, almost obsessive documentation. That was the absolute key. Her captain kept a detailed logbook. Every single person who boarded the yacht, the date, the time, the business purpose of the trip, photos were taken, receipts for fuel, maintenance, crew, everything were kept. She could directly demonstrate that the yacht was instrumental in closing specific deals and generating substantial commission income.
So it wasn't just for pleasure cruises disguised as business.
Exactly. The IRS only cares if an expense is ordinary and necessary and reasonable in relation to the income it helps generate for that specific business. For her high-end waterfront niche, she successfully argued the yacht met those tests. It boils down to legitimate business intent and proof.
Incredible story. So, wrapping this part up, what does this all mean for someone, say, earning a solid six figures, but maybe they're still just using TurboTax?
Look, if you're earning six figures, especially if you have any investments, a side hustle, maybe own a home with a mortgage or have kids, and you're just using basic software like TurboTax, you're almost certainly leaving money on the table. Probably a lot of money.
Why?
Because that software is great for simple W-2 returns, but it can't ask you the probing questions. It can't understand the nuances of your specific situation. It can't strategize about things like S-Corp, cost segregation, or the Augusta rule. You'll miss out on deductions and credits you're legally entitled to simply because you don't know to look for them or how to claim them properly. It's about being proactive with the rules, not just reactive come tax time.
Proactive, not reactive.
Mm.
Okay. What's fascinating here is just how much the tax code keeps changing and how many layers there are to peel back.
It's endlessly complex, which, leads to an interesting thought experiment. If I had a magic wand and could rewrite the entire U.S. tax system from scratch,
Okay, fantasy time. What would you do?
I would make it radically simpler, maybe just 100 pages instead of the current 80,000 plus. I'd probably implement a single flat tax rate, maybe 15%, for everyone and every type of income. No complex brackets.
Buy tax. It's controversial.
Definitely. I'd also abolish property taxes entirely. I just think it's fundamentally wrong that you can pay off your house mortgage after 30 years, own it free and clear, but still have to pay thousands every year just to keep it, or the government takes it.
Get rid of property taxes. Wow.
And I'd eliminate most, if not all, government subsidies and targeted tax credits. My focus would be purely on tax deductions for things that grow the economy.
Okay.
Deductions for business investment, for taking risks, for employing people. Incentivize creation, not consumption through credits.
That's definitely a provocative vision, a much simpler, maybe harsher for some, system focused purely on economic incentives. All right, so for you, our listener, as we wrap up this deep dive, here's a final thought to chew on. If the tax code truly is a game, like we've discussed, and the government sets the rules to encourage certain moves, what's one personal or business investment you could potentially make in the next year? Something that aligns with your own financial goals, yes, but could also maybe turn some of your current expenses into strategic tax advantages. How can you shift your role from just being a passive pawn reacting to the rules to becoming an active strategist in this complex, fascinating game?